Okay, well, thank you very much for inviting me to this panel, which I think is tremendously important. I mean, as far as I can see, sustainable finance has two meanings. One is ongoing finance, and the other one is environmentally relevant finance. And I'd like to say a little bit about both. First of all, as the Minister said, Greece is growing quite strongly at the moment. It's certainly on the map for international investors. And I have to say, we've been through two crises, coronavirus, energy prices, and now perhaps there's a third crisis that we have to confront, which is the raise in interest rates across the world, not just in Europe. What is therefore very important is how the banking system is going to react to this increase in interest rates. I think, as was discussed before, in a sense the banking sector is in a good state. Deposits are up after coronavirus. NPLs are down to 10%, and liquidity is looking good. But as well as that, I think there's a second reason that I'm rather confident about the continued intermediation of loans, and that's because of the loans program of the Recovery and Resilience Plan. Now, this is quite a big program. It's some 12.7 billion, as Julia mentioned earlier. It effectively provides a zero interest rate financing for up to half of an investment. So, for instance, a supermarket chain has signed a loan with one of the banks. The total value of the investment is 12.6 million, and 6.3 million comes from the RRP. In this particular case, of course, the effective interest rate on the investment is considerably lower than the market interest rate. And actually, I would say things are going quite quickly. At the moment, there's some 600 million of RRP-related loans, which I guess means there's about 1.2 billion worth of investments which are being financed. And this is really very significant. And if you take the 12.7 billion and say, well, that would allow maybe up to 25.4 billion worth of investments, which is of the order of, 12.5% of GDP. This is big and potentially very significant. And I think this is an important reason that you could be relatively positive about the inward foreign investment into Greece being also reflected by active domestic investment. So I think that's the first thing which is worth saying. Now, I would say that crucial to this is that the banks themselves keep their margins where they are and don't use the scheme to increase their margins. But I think otherwise, on the domestic front, it looks rather positive. But I would say that there is another challenge, and this is a challenge again for the banks to address. And this is, I think, the challenge of the energy shock. Clearly, there is a need to make very urgent investments in the corporate sector, which are energy saving. As you know, the European Council reckons that gas demand needs to be reduced by 15% by March, which is quite ambitious. And it's very clear that it's important that banks take this on board. Now, I have to say that energy investments for the corporate sector are much more complicated than the ex economo scheme. They reflect installation of renewables, they reflect digitization of production, they reflect various other improvements, heat pumps and LED lighting. And I think there are two issues which I think need to be addressed there. And if I can just mention them quickly. I think the first one, and an important one, is it's fine for the bigger firms to do studies, etc., for these investments. But it seems to me that's much more difficult for smaller firms. And I think from that point of view, it's important that the banks and also the public sector try to do something in terms of making such loan approvals more automatic. And secondly, it's crucial what the energy price assumption of these studies is. And from that point of view, I think there's a very good argument for some public subsidy for such investments. Actually, such subsidies do exist within the Recovery Fund, but I think it's very important that these energy-saving subsidies and the digital subsidies, which are already available, are focused particularly on such investments. So I think what I have to say is hopefully quite optimistic, but I think it puts a big burden on the banks to actually implement this. Thanks very much.
Thank you very much.